Before we begin, it's crucial to understand that the content in this presentation is for informational and educational purposes only. It is not, and should not be considered, financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. The potential for substantial loss exists, and you should only trade with capital you can afford to lose. Past performance is not indicative of future results. We strongly encourage you to consult with a licensed financial advisor to determine if Forex trading is appropriate for your personal financial situation and risk tolerance. Picture this. It's 2 in the morning, the harsh blue light of your monitors painting the room. You're mainlining coffee, your eyes are burning, and you're staring at a candlestick chart that's starting to look more like a Rorschach test. The London session is kicking into high gear, and you just know there's a move coming. You see a potential setup on the euro/dollar pair. Your heart starts to pound. Is this it? Is the pattern clear enough? You hesitate for a second, a flicker of doubt, and poof, the moment's gone. The price rips upward without you. Or worse, you jump in driven by that fear of missing out, and the market immediately reverses, stopping you out for a loss. If any part of that sounds familiar, you've felt the brutal, unforgiving reality of manual Forex trading. It's a grind. It's a battle not just against the market, but against your own human limitations. Your need to sleep, your emotions, the greed that makes you hold a winner too long, the fear that makes you cut a good trade too early, the anger that leads to revenge trading. It's the sheer impossibility of processing the tidal wave of information hitting the markets every single second. Economic data from the U.S. Bureau of Labor Statistics, a surprise announcement from the European Central Bank, political tweets, shifts in oil prices. It's a constant onslaught. For decades, this was the game. The trader with the most discipline, the most screen time, the fastest reaction had the edge. But what if the very nature of that edge is changing? What if you could have a partner working for you that never sleeps, never gets emotional, and can analyze millions of data points in the time it takes you to blink? This isn't a far-off, futuristic concept. This is the reality of artificial intelligence in the Forex market, and it is creating a seismic shift for traders right here in the United States. Over the course of this series, we are going to pull back the curtain on this technological revolution. We're not talking about those scammy, set it and forget it black box bots you see advertised everywhere. We are talking about a fundamental paradigm shift in how market analysis, risk management, and trade execution are being approached. We're going to break down the 3 core ways that sophisticated AI is being used by savvy traders to gain a potential edge. We'll explore the specific types of tools and platforms becoming available to retail traders in the US, and how to navigate this new landscape. Most importantly, you will learn how you can potentially integrate these technologies into your own strategy to augment your own intelligence, helping you make more data-driven, systematic, and less emotional trading decisions. The first and perhaps most profound change AI brings to the table is its ability to solve the human problem. Let's start with the most obvious constraint: the clock. The Forex market is a 24-hour, 5-day-a-week beast. It doesn't care if you're asleep. Major economic news from Japan can rock the dollar/yen pair, while you're in your deepest REM cycle. The opening of the London market, one of the most volatile times of the day, happens while most of the US is still dark. A human trader has to make a choice: become a nocturnal creature, miss potential opportunities, or focus on a single session, effectively ignoring 2/3 of the market's activity. AI has no such limitations. An AI-driven system can monitor all major currency pairs across all trading sessions without a single break. It can be programmed to identify a very specific set of criteria for a high-probability setup. Let's say, a combination of moving average crossovers, RSI divergence, and a specific candlestick pattern on the 1-hour chart. It can scan for that exact setup on the Aussie/dollar during the Tokyo session, the pound/yen during the London session, and the dollar/Swiss during the New York session simultaneously. It never gets tired. It never gets distracted. It never misses a potential setup because it was grabbing a cup of coffee. It provides a level of vigilance that is physically impossible for a human being to replicate. But being awake is only half the battle. The bigger demon for most traders is emotion. Every trading book ever written has a chapter on psychology, because we are hardwired to make terrible financial decisions under pressure. When a trade is going our way, we feel euphoria and greed, often leading us to abandon our profit targets in hopes of a bigger score, only to watch the trade reverse and turn into a loser. When a trade goes against us, we feel fear and panic, cutting it loose before it has a chance to work, or worse, we feel hope and we move our stop loss just a little bit further, violating our own rules and risking a catastrophic loss. AI has no emotions. It is pure, unadulterated logic. It operates entirely on the parameters and rules you set for it. It doesn't know greed. It doesn't feel fear. When a trade hits its predefined profit target, the AI will execute the close. It won't get tempted to hang on for a few more pips. If a trade hits a stop loss, the AI will exit the position, protecting your capital. It won't feel the sting of being wrong and try to revenge trade to make the money back. It acts as the ultimate discipline partner. Think of it like this. You are the captain of the ship, setting the destination and the overall course. That's your strategy. The AI is your highly trained, unflappable pilot, executing the complex maneuvers of flying the plane through turbulence, sticking to the flight plan no matter how scary the storm looks outside. It enforces the discipline that, even with the best intentions, humans struggle to maintain. Finally, let's talk about the sheer scale of information. A successful trader in the modern era needs to be part economist, part political scientist, part statistician. You need to understand how U.S. inflation data might affect the Federal Reserve's interest rate decisions, and how that, in turn, will impact the dollar. You need to watch commodity prices, bond yields, and stock market indices, because these are all interconnected pieces of a giant, global puzzle. Trying to process this flood of information, this data tsunami, in real time is an exercise in futility for the human brain. We can only focus on a few things at once. This is where a specific branch of AI, machine learning, truly shines. Machine learning algorithms can be trained on decades of historical market data. They can sift through millions of data points, identifying subtle correlations and patterns that no human chart gazer would ever spot. For example, a machine learning model might discover a non-obvious correlation between the price of copper, the Australian 10-year bond yield, and the probability of a reversal in the Aussie/US dollar pair over the next 4 hours. It can analyze the text and sentiment of thousands of news articles and social media posts in seconds to gauge market mood following a central bank announcement. It's not just looking at price action. It's building a multidimensional understanding of the market's underlying forces. It turns the overwhelming noise of the market into a clearer, actionable signal. So we've established the core problem. As human traders, we are limited by our need for sleep, our emotional biases, and our cognitive capacity to process information. And we've introduced the solution: an AI co-pilot that is tireless, emotionless, and possesses a near-infinite capacity for data analysis. This is the foundation. But how does this technology actually work in practice? How does an algorithm go from analyzing sentiment in news articles to actually identifying a trade entry and exit? What are the different types of AI, from simple algorithms to complex neural networks, and what role does each one play? That's where we begin to peel back the layers and look at the engine driving this revolution. Let's start with the most basic form of what people often call trading AI: rule-based systems. Think of these as the foot soldiers of algorithmic trading. They are not intelligent in the way we think of consciousness or learning. Instead, they are masters of execution, following a set of pre-programmed, rigid instructions with lightning speed and zero emotion. The logic is simple. If X happens, then do Y. A classic example in Forex would be a strategy built around moving average crossovers. A US trader might program a system with this rule. If the 50-period simple moving average on the euro to US dollar 1-hour chart crosses above the 200-period simple moving average, then execute a buy order. Conversely, if it crosses below, execute a sell. The system doesn't understand why a moving average crossover might be significant. It doesn't know about market sentiment, Federal Reserve announcements, or non-farm payroll data. It only knows its one specific rule. If the condition is met, it acts. If not, it waits. For decades, this was the bedrock of automated trading. Many of the expert advisors, or EAs, that became popular on platforms like MetaTrader were, at their core, sophisticated rule-based systems. Their value isn't in their intelligence, but in their discipline. A rule-based system will never get greedy and hold a winning trade too long. It will never get scared and exit a trade prematurely. It follows the plan 24 hours a day, 5 days a week, without ever needing a coffee break. But its greatest strength is also its greatest weakness: its rigidity. The market is a fluid, ever-changing environment. A rule that worked beautifully in a trending market last year might get completely shredded in a choppy, sideways market this year. The rule-based system can't adapt. It will keep applying the same logic, even if the context has fundamentally changed, potentially leading to a series of losses. It's like a pilot who only knows how to fly in clear weather. The moment a storm appears, the pre-programmed checklist is no longer sufficient. This is where the next and far more revolutionary layer comes in: machine learning. If rule-based systems are about following instructions, machine learning is about learning the instructions from scratch. This is a monumental leap. Instead of a human programmer trying to define a good trading strategy, you let the machine figure it out by analyzing vast amounts of historical data. You don't tell it what the rules are. You give it the data and ask it to find the patterns that have historically led to profitable outcomes. Within machine learning, there are a couple of key approaches that are transforming Forex trading. The first is called supervised learning. Think of it like a student studying for a test with a stack of flashcards. On one side of the card is the question, a snapshot of market data. This could include hundreds of variables: the price of the US dollar to Japanese yen, trading volume, the time of day, the value of various technical indicators, maybe even the price of gold or oil at that exact moment. On the other side of the card is the answer. What happened next? Did the price go up, down, or stay flat in the following hour? You feed the machine learning model thousands, or even millions of these flashcards. The model pores over them, relentlessly searching for subtle relationships and correlations between the questions and the answers. It might discover that a specific combination of low volatility, high volume, and a certain candlestick pattern on a Tuesday morning has historically preceded a price increase 80% of the time. This isn't a rule a human programmed. It's a probabilistic pattern the machine discovered itself. Once trained on this historical data, the model can then be let loose on live market data. When it sees a new set of conditions that match a pattern it learned, it can make a prediction about the future price movement. The second approach is unsupervised learning, and this is where things get even more interesting. With supervised learning, we had to provide the answers on the flashcards. But what if we don't know the answers? What if we don't even know the right questions to ask? With unsupervised learning, you just give the machine a massive unlabeled dataset and tell it, find the structure in this. Group what's similar. Tell me what I'm missing. In Forex, this is incredibly powerful for identifying what traders call market regimes. The market doesn't just behave in one way. Sometimes it's in a strong, clear uptrend. Sometimes it's in a volatile, choppy downtrend. Other times it's stuck in a quiet sideways range. A human trader learns to recognize these regimes through experience. An unsupervised learning algorithm can identify them mathematically. It can analyze years of price data and cluster it into, say, 4 or 5 distinct regimes, each with its own unique statistical properties of volatility and momentum. A trading strategy that works in a high volatility trending regime is likely to fail in a low volatility ranging regime. By using an AI to first identify the current market regime, a trader can then deploy the most appropriate strategy for those specific conditions. The AI isn't just predicting a trade, it's providing crucial context about the entire market environment. But even machine learning has its limits. It's fantastic at finding patterns, but it can sometimes struggle with the sheer complexity and noise of financial markets. This brings us to the cutting edge, the third and most advanced layer, deep learning and neural networks. If machine learning is like a brilliant student who can cram for a test, deep learning is like trying to build a digital brain. It's a subfield of machine learning that uses structures called artificial neural networks, which are loosely inspired by the biological neurons in our own heads. These networks are arranged in layers. The input data, raw price information, goes into the first layer. The neurons in this layer process it and pass their output to the next layer, which processes it further, and so on through multiple layers. Each successive layer is able to recognize more and more complex and abstract patterns in the data. Let's use an analogy. Imagine you want an AI to recognize a head and shoulders chart pattern, a classic indicator of a potential trend reversal. A simple machine learning model might struggle with all the variations, but a deep learning neural network would tackle it in layers. The first layer might just learn to identify simple lines, upward slopes, downward slopes, and horizontal lines. The second layer would learn to combine those lines into basic shapes, like peaks and troughs. The third layer would learn to recognize combinations of those shapes, like a small peak followed by a large peak, followed by another small peak. Finally, the top layer would take that structure and classify it. This is a head and shoulders pattern. It builds a sophisticated understanding from the ground up, without being explicitly told what a head and shoulders pattern even is. In Forex, this ability to learn hierarchical patterns is a game changer. The market is driven by an almost infinite number of interacting factors. A neural network can be fed raw data from dozens of sources, tick-by-tick price data for multiple currency pairs, order book information, news headlines from financial wires, even social media sentiment from US traders on Twitter. The deep learning model can sift through all of this nonlinear, messy data and find predictive patterns that are simply invisible to the human eye or even to simpler machine learning models. Specifically, a type of neural network called a long short-term memory network, or LSTM, is exceptionally well suited for Forex. Financial markets are a time series. What happened a minute ago is deeply relevant to what might happen next. LSTMs are designed with a kind of memory, allowing them to remember important information from earlier in the data sequence while discarding what's irrelevant. This is a profound advantage over traditional indicators that might only look at the last 20 or 50 candles. An LSTM can potentially recognize that the market's reaction to a specific economic data released today is similar to its reaction 6 months ago, and factor that memory into its prediction. So we have this spectrum, from the rigid instruction-following rule-based systems to the pattern-finding capabilities of machine learning, all the way to the complex brain-inspired architecture of deep learning neural networks. Understanding this spectrum is crucial for any US trader looking to engage with AI tools. It allows you to ask the right questions. When you see a new trading bot or a new piece of analysis software, you can now ask, what's under the hood? Is this just a simple if-then script? Or is it a dynamic learning model that can adapt as market conditions change? But knowing the different types of AI is only the first step. The real question is, how are these powerful technologies actually being applied? How does a machine go from analyzing data to performing the concrete tasks that traders do every day? We're not just talking about placing buy and sell orders. We're talking about AI that can read the news and gauge the market's mood, AI that can manage risk across an entire portfolio, and AI that can spot a market crash before it even happens. Moving beyond the what and into the how is where the practical application for traders truly begins to take shape. So let's pull back the curtain. How does an algorithm actually learn to read the market's mind? It's not magic. It's a brute force approach to data processing on a scale that the human brain simply cannot comprehend. Think of a seasoned trader, someone with decades of experience. They've developed an intuition, a gut feeling, based on seeing thousands of chart patterns, hearing countless news announcements, and living through market cycles. They subconsciously recognize subtle cues that signal a potential shift. Now, imagine a system that could do the same thing, but instead of seeing thousands of examples, it sees billions. And instead of taking 30 years, it does it in a matter of hours. That is the essence of machine learning in Forex. The process starts with data, an almost unimaginable amount of it. We're talking about decades of historical price data for every currency pair, tick by tick. But that's just the kindergarten level. A sophisticated AI model also ingests real-time news feeds from hundreds of global sources, from the Wall Street Journal to Reuters. It analyzes the language in central bank statements, looking for subtle shifts in tone. A change from strong growth to moderate growth can be a massive signal. It scrapes economic calendars, understanding the potential impact of non-farm payrolls in the US or an interest rate decision from the Bank of Japan. It even dives into the wild west of social media, using what's called natural language processing to gauge the real-time sentiment of millions of traders, analysts, and bots on platforms like X. It's looking for spikes in fear, greed, or uncertainty related to a specific currency. The AI then uses algorithms, most notably neural networks, to find hidden patterns within this chaos of data. A neural network is loosely modeled on the human brain. It has layers of interconnected neurons that process information. When you feed it all that market data, you're essentially training it. You show it a historical setup, a combination of price action, news, and sentiment, and then you show it what happened next. Did the market go up, down, or sideways? The network makes a prediction. If it's wrong, it adjusts the connections between its neurons. If it's right, it reinforces those connections. Now repeat this process a billion times. The AI isn't just memorizing that this pattern leads to that outcome. It's learning the incredibly complex, nonlinear relationships between thousands of variables. It might discover that a certain phrase used by the Federal Reserve Chairman, combined with a specific level of volatility in the bond market, has historically preceded a drop in the US dollar to Japanese yen pair 78% of the time within the next 4 hours. This is a correlation a human analyst might never, ever find. This predictive power is the engine behind the next evolution of trading, truly intelligent algorithmic trading. For years, US traders have had access to expert advisors or trading bots. But historically, most of these were quite rigid. They operated on simple if-then logic. For example, if the 50-day moving average crosses above the 200-day moving average, then execute a buy order. This works fine in a specific type of trending market. But the moment the market becomes choppy or a major news event breaks, that rigid logic fails, often spectacularly. The bot doesn't know how to adapt. It just keeps executing its pre-programmed rules, even if the context has completely changed. AI-powered bots are a different species altogether. They use a concept called reinforcement learning. Imagine you're teaching a dog a new trick. You give it a treat for doing it right and say no when it does it wrong. Reinforcement learning is similar, but for an algorithm. The AI is placed in a simulated market environment with historical data. It can take actions, buy, sell, or hold. When it makes a simulated trade that results in a profit, it gets a digital reward. When it loses, it gets a penalty. The AI's only goal is to maximize its total reward. It will run through millions, even billions of simulated trades, trying every conceivable strategy. It will learn on its own when to be aggressive and when to be conservative. It will discover that its old moving average strategy only works on Tuesdays when volatility is low. But on Fridays during the London-New York overlap, a completely different approach is needed. It adapts. It evolves. It's no longer a static set of rules. It's a dynamic strategy engine that's constantly learning from the market's ever-changing behavior. For the US trader, this opens up a new frontier. Many regulated US brokers now offer robust API access. An API is basically a bridge that allows third-party software to connect directly to your trading account. This means a trader can potentially link a sophisticated AI-driven trading system to their own brokerage account, allowing the AI to analyze and, depending on its design, even execute trades based on its complex adaptive logic. But perhaps the most profound application of AI for the everyday trader isn't in predicting the next big move, but in managing the risks of being wrong. This is where AI transitions from a speculative tool to an indispensable co-pilot. Traditional risk management is often static. You set a stop-loss at 2% of your account balance and that's it. But what if that 2% is arbitrary? In a low-volatility market, a 2% stop-loss might be too wide, leaving potential profit on the table. In a wildly volatile market, it might be too tight, getting you stopped out by random noise before your trade idea has a chance to play out. An AI approaches risk dynamically. Before a trade is even placed, it can run thousands of simulations based on current market volatility and historical precedents. It might determine that for this specific trade on the pound sterling to US dollar, the optimal stop-loss isn't a fixed percentage, but a dynamically calculated level just below a key support zone, giving the trade the best statistical chance of success while still protecting the downside. It can also calculate the optimal position size in real time. Instead of you just trading one standard lot every time, the AI might suggest trading 1.2 lots on a high probability setup in a low volatility environment, and only 0.5 lots on a more speculative trade when the market is choppy. This dynamic position sizing is one of the key habits of professional traders, and AI makes that level of sophistication accessible. On a portfolio level, it's even more powerful. Let's say you're a trader from Texas named Alex. Alex has a few positions open. He's buying the Australian dollar against the US dollar, and also buying the New Zealand dollar against the US dollar. To him, they're two separate trades. But an AI risk management tool sees something else. It instantly analyzes the historical correlation between the Aussie and the Kiwi dollars and sees they move together over 85% of the time. The AI flags this for Alex, showing him that he doesn't have two separate trades. He has one highly concentrated bet on commodity currencies. If bad news comes out of China, a major trading partner for both Australia and New Zealand, both of his positions are likely to go down at the same time. His risk is doubled without him even realizing it. The AI might then suggest reducing his position size in one of the pairs, or even adding a small hedge to offset some of that concentrated risk. This is the practical reality of how AI is being integrated. It's not some black box that just prints money. It's a suite of powerful analytical and risk management tools. Think of it less like a self-driving car that you just fall asleep in, and more like the most advanced cockpit in the world. You, the trader, are still the pilot. You set the destination, your overall strategy, your risk tolerance, your financial goals. The AI is your co-pilot and your flight navigation system. It's monitoring thousands of data points, alerting you to potential dangers you can't see, calculating the most efficient route, and handling the complex background tasks, freeing you up to make the critical, high-level decisions. It's about augmenting human intuition with machine-scale data processing. The result is a potential shift from trading based on emotion and gut feeling to a more data-driven, probabilistic approach. The AI can help answer critical questions. What is the historical probability of this pattern working out? What is the optimal risk-reward for this specific setup given current volatility? Am I overexposed in my portfolio right now? These are questions that, until recently, were only answerable by elite quantitative hedge funds. Now that power is slowly trickling down. But with all this incredible power comes a new set of challenges and pitfalls. What happens when the AI gets it wrong? Because it will. How do you avoid becoming completely dependent on the algorithm and losing your own market sense? And more importantly, in a market now flooded with promises of AI-powered riches, how can you tell a legitimate, data-driven tool from the thousands of scams designed to do nothing more than drain your trading account? That fragile line between a powerful tool and a dangerous weapon is exactly where we're going next. It's a digital minefield. On one side, you have groundbreaking technology with the potential to reshape your entire trading methodology. On the other, a siren's call from digital charlatans, promising effortless wealth but leading you straight onto the rocks of a blown account. The difference between the two isn't always obvious. In fact, the most dangerous scams are the ones that look the most legitimate. They use the right buzzwords: neural networks, deep learning, quantitative analysis, but it's all a sophisticated veneer, a mask hiding an empty, account-draining engine. So let's arm ourselves. Let's build a filter, a mental framework to instantly sift the gold from the garbage. We'll start with the blaring red flags, the warning signs that should make you run, not walk, in the other direction. First and foremost is what I call the secret black box pitch. The seller tells you their AI is powered by a revolutionary, top-secret algorithm that's so advanced, they can't possibly reveal how it works. They'll say it was developed by X-hedge fund quants or a mysterious coding genius. It's pure theater. Think about it. In any other professional field, a lack of transparency is a deal-breaker. Would you let a surgeon operate on you if they said, "I have a secret new technique, I can't tell you what it is, just trust me"? Of course not. While a company has every right to protect its proprietary code, they should be able to clearly explain the strategy. Is it a trend-following system? Does it look for mean reversion? Does it trade news breakouts? If the vendor can't or won't explain the fundamental logic behind their AI, it's not because it's too secret. It's often because there is no logic. It's a random signal generator wrapped in a fancy marketing campaign. The second massive red flag is the promise of absurdly high, unnaturally consistent returns. You'll see advertisements showing a perfect, 45-degree equity curve going straight up, with claims of 98% win rates, or doubling your account every month. This is a direct assault on the fundamental nature of markets. No trading strategy, human or AI, wins all the time. Markets are chaotic and unpredictable. Professional traders and legitimate AI systems are built around managing losses, not avoiding them. These perfect backtests, they show you, are almost always the product of something called curve fitting. This is where an algorithm is so over-optimized for a specific set of historical data that it looks perfect in the rearview mirror. But the moment you apply it to live, unpredictable market conditions, it falls apart spectacularly. A legitimate developer will show you the ugly parts. They'll show you the drawdowns, the periods of stagnation, the losing trades. They're not selling a fantasy. They're providing a tool for navigating reality. Third, be hyper-aware of high-pressure sales tactics. This is Psychology 101. Scammers exploit our natural fear of missing out, or FOMO. You'll see countdown timers on their websites. Offer ends in 2 hours. You'll see claims of artificial scarcity. Only 3 copies left at this price. This is designed to short-circuit your critical thinking. It rushes you into making an emotional decision before your logical brain has a chance to ask the tough questions. A truly valuable, professional-grade tool doesn't need these cheap tricks. Its performance, transparency, and reputation speak for themselves. The product is available today, it will be available tomorrow, and the price is based on its value, not on a ticking clock. If you feel like you're in a late-night infomercial, close the browser tab. Finally, the fourth red flag is a lack of verifiable proof. Scammers love to show you screenshots of a MetaTrader account with a massive balance. What they don't tell you is that these can be easily faked. You can run a strategy in a demo account, cherry-pick the one that got lucky, and present it as evidence. Or worse, use software to edit the image itself. The gold standard for proof in the retail Forex world is a third-party verified track record. Services like MIFSbook or FXBlue link directly to a broker's trading account and import the data independently. This can't be faked. It shows every trade, every win, every loss, the drawdown, the profit factor, everything. If a vendor isn't willing to link to a live, third-party verified account with a meaningful history, you have to ask yourself one question. What are they hiding? Now let's flip the coin. We know what to avoid. What should we actively look for? What are the green lights, the hallmarks of a legitimate, powerful AI trading tool? The first green light is the polar opposite of the black box. A clear, understandable methodology. The provider should be able to articulate what their AI does and why. For example, they might say, "Our AI uses a machine learning model to analyze news sentiment from hundreds of sources, and it combines that with technical analysis of price momentum on the 4-hour chart to identify potential breakout trades." See the difference? You don't need to see the code, but you understand the concept. This is crucial because no strategy works in all market conditions. By understanding the AI's logic, you, the trader, can make an informed decision about when it's most likely to perform well, and more importantly, when it might be better to switch it off, like during periods of extreme, unpredictable volatility. Second, look for comprehensive and realistic performance data. We're not talking about a simple backtest over a bullish year. We're talking about rigorous stress testing. A quality provider will show you how the AI performed over many years through different market regimes. They'll show you the 2008 financial crisis. They'll show you the 2020 pandemic crash. They'll show you long, sideways, choppy markets. They might even provide a Monte Carlo simulation, which runs thousands of variations to determine the probable range of future outcomes. They are not trying to sell you on a perfect past. They are trying to give you confidence that the tool is robust enough to handle an imperfect future. The third, and perhaps most important, green light is an obsessive focus on risk management. A scam talks only about profits. A professional tool talks endlessly about risk. Look for features that give you, the trader, ultimate control. Can you adjust the stop-loss parameters? Can you define the maximum risk per trade as a percentage of your account? Does it have a max daily drawdown feature that automatically shuts the system down for the day if it hits a certain loss limit? These are the features designed by people who actually understand trading. They know that long-term success isn't about hitting home runs. It's about protecting your capital so you can stay in the game long enough to have a fighting chance. The AI should be your co-pilot, but you must always be the captain with final say over how much risk your portfolio is exposed to. And finally, look for evidence of a strong community and ongoing support. A scam is a transaction. A legitimate product is a relationship. Is there a user forum? A Discord channel? A dedicated support team that answers questions promptly? Do the developers release regular updates to adapt the AI to changing market conditions? When you buy a tool from a reputable company, you're not just buying a piece of software, you're buying into an ecosystem. This network is an invaluable resource, allowing you to learn from other traders, share insights, and get help when you need it. A scammer takes your money and vanishes. A real company invests in your success because their reputation depends on it. Ultimately, this brings us to the most critical concept for any US trader looking to integrate AI: the human-in-the-loop principle. The biggest mistake a trader can make is to view an AI tool as a magic, set-and-forget solution. That is the path to ruin. The most advanced AI is not a replacement for your judgment. It's an enhancement for it. It's a tireless analyst that can watch every tick of every currency pair, 24 hours a day without emotion or fatigue. It can spot patterns and correlations that are invisible to the human eye. But it doesn't understand a surprise Federal Reserve announcement. It doesn't have the intuition to feel when market sentiment is shifting in a way that defies its algorithm. That's where you come in. Your role is to be the strategist, the risk manager, the final decision maker. You use the AI to generate high-probability trade ideas, but you apply your own analysis and discretion before pulling the trigger. You use the AI to manage trades, but you know when to intervene manually if the context changes. It's a partnership, a symbiosis of human intuition and machine calculation. So now we have a robust framework for telling the difference between a potent trading assistant and a predatory scam. We know the red flags to avoid and the green lights to seek out. But this leads to the next logical question. What do these legitimate tools actually look like in practice? What are the different categories of AI software that are actually out there, available to you right now? From signal generators to fully automated systems and beyond, the landscape is more diverse than you might think. And mapping out that landscape is our very next mission. So let's break it down. When we say AI trading software, we're not talking about one single thing. We're talking about a spectrum of tools, each with a different level of control, a different philosophy, and a different role to play in a trader's toolkit. Think of it less like buying a car and more like assembling a team. You need to know each player's position. First up, at the most accessible end of the spectrum, you have AI-powered signal generators. These are probably the most common entry point for traders curious about AI. The concept is simple. The software does the heavy lifting of market analysis and then presents you, the trader, with a suggestion. A signal. It might say, potential buy opportunity on euro to US dollar at this price, with a suggested stop loss here and a take profit target there. But that's where its job ends. It doesn't touch your account. It doesn't place the trade. It's an advisor, not an actor. The final decision to pull the trigger rests entirely on your shoulders. Think of it like having a world-class but very specialized analyst sitting next to you. This analyst has read every economic report, analyzed every chart pattern from the last 20 years, and monitored global news sentiment, all in the blink of an eye. Then it leans over and whispers, hey, based on criteria X, Y, and Z, you might want to take a look at this. You still have to use your own judgment. Does this signal fit your personal trading plan? Does it align with your risk tolerance? Do you agree with the analysis? This human-in-the-loop approach is a massive benefit for many US traders. It allows you to leverage the immense data processing power of AI without surrendering control of your capital. It's a tool for augmenting your own skills, not replacing them. The potential downside? The quality of these signals can vary dramatically from one provider to the next. Some are based on robust, multi-layered algorithms, while others might be little more than dressed-up traditional indicators. Blindly following any signal without your own due diligence is a recipe for disaster. Moving one step up the ladder, we find the semi-automated AI trading assistants. This is where things get more interactive. These tools go beyond just providing signals. They actively help you manage the trades you decide to take. This isn't about full automation. You're still the one identifying the opportunity and entering the market. But once you're in a trade, the AI assistant can take over some of the tactical management. For example, you might enter a long position on the pound sterling to Japanese yen, and the AI assistant, constantly analyzing microfluctuations and volatility, could dynamically adjust your trailing stop loss to lock in gains more effectively than a standard fixed trailing stop ever could. Or, it might identify optimal points to scale out of a position, taking partial profits at levels determined by its real-time analysis of market momentum. This is like being the captain of a ship. You decide the destination and set the overall course. But you have a highly advanced first mate handling the minute-to-minute adjustments of the sails and rudder to navigate the changing winds and currents. The advantage here is a significant reduction in the emotional and mental load of in-trade management. How many times has a trader closed a position too early out of fear, or let a loser run too long out of hope? An AI assistant doesn't have those emotions. It executes the management strategy you've approved with cold, hard logic. This can enforce discipline and potentially optimize exits. The risk, however, is in the setup. These tools require a clear understanding of their parameters. If you configure the assistant with poor logic or inappropriate settings for the current market conditions, it can manage a good trade right into a loss. It's a powerful tool, but it's not a mind reader. It only works within the framework you provide. Next, we arrive at the category that gets all the headlines: the fully automated AI trading systems. These are often known in the MetaTrader world as expert advisors, or more colloquially, trading bots. This is the realm of hands-off execution. Here, the AI is designed to handle the entire process from start to finish. It scans the markets based on its core programming, identifies what it perceives as a valid setup, calculates position size, enters the trade, manages the stop loss and take profit, and exits the position, all without a single click from you. This could happen at 3 a.m. while you're fast asleep. The appeal is obvious. It taps into the dream of leveraging technology to participate in the market 24 hours a day, 5 days a week, removing human error and emotion from the equation entirely. The technology here can be incredibly sophisticated, sometimes employing neural networks that attempt to learn and adapt to changing market dynamics. When a well-designed system is operating in a market condition it was built for, the results can be remarkably consistent. It can execute with a speed and discipline that is physically impossible for a human trader. However, this category also carries the most significant risks. There's the infamous black box problem, where you don't always know the specific reason the AI entered a trade, making it difficult to trust. More critically, there's the danger of overfitting. An AI can be so perfectly tuned to historical data that it performs brilliantly in backtests, only to fall apart the moment it encounters a live market environment it hasn't seen before. A sudden news event, a shift in volatility, these can wreck a system that isn't robust. The idea of set it and forget it is a dangerous myth. These systems require constant monitoring, periodic reevaluation, and the understanding that no single strategy, automated or otherwise, works perfectly forever. Finally, there's a fourth and incredibly valuable category that often gets overlooked: AI-driven market scanners and analytics platforms. These tools are not designed to trade for you at all, either directly or by suggestion. Instead, their purpose is to give you, the discretionary trader, a superpower. They use AI to perform a different kind of task, finding the needle in the haystack of global financial data. An AI scanner might sift through all 28 major currency pairs in real time, looking for a very specific confluence of technical patterns and sentiment scores that you've defined. It doesn't tell you to buy or sell. It simply says, hey, that very specific set of conditions you're interested in? It's happening right now on the Australian dollar to Canadian dollar 4-hour chart. Other platforms might use natural language processing to scan thousands of news articles, central bank statements, and even social media posts, distilling it all into a single, quantifiable market sentiment score. This is about augmenting your intelligence as a trader. It's like having a team of 1,000 research assistants working for you around the clock, filtering out all the noise and delivering only the most relevant, actionable information to your desk. This empowers you to make better, faster, more data-driven decisions yourself. It enhances your own strategy rather than trying to impose one on you. The primary challenge here isn't financial risk from the tool itself, but the potential for information overload. The data is only useful if you know how to interpret it and integrate it into a coherent trading plan. So we have these four main archetypes: the signal generator as the advisor, the semi-automated assistant as the co-pilot, the fully automated system as the chauffeur, and the analytics platform as your intelligence agency. Each serves a different purpose, and each comes with its own unique set of considerations. Knowing which type of tool aligns with your personality, your trading style, and your goals is the absolute first step. But it immediately raises the next, even more critical question. Once you know what you're looking for, in a market flooded with promises and flashy websites, how do you even begin to separate the genuinely powerful tools from the worthless digital snake oil? How do you look under the hood and really evaluate what you're getting? That process of due diligence is what separates informed traders from hopeful gamblers, and it's precisely where we're going next. Think of it like buying a high-performance car. The salesperson can tell you all about the 0 to 60 time, the horsepower, the sleek design, but you wouldn't buy it without looking at the vehicle history report, taking it for a test drive, and understanding what's actually under the hood. The world of AI trading tools is no different. The marketing is the shiny paint job. Our job is to be the savvy mechanic, not the mesmerized customer. So let's pop the hood. We're going to build a 4-point inspection checklist, a framework you can use to systematically dissect any AI trading tool that crosses your path. This isn't about complex coding. It's about asking the right questions. First on our checklist, deconstructing the backtest. A backtest is when a trading strategy is run on historical price data to see how it would have performed in the past. It is the single most common piece of proof that vendors will offer you. But a backtest can be a powerful tool for analysis or a masterclass in deception. The difference is in the details. The first red flag is a provider who offers no backtest at all. If they haven't tested their own system on historical data, what are they even selling? It's like a pilot saying they've never used a flight simulator. You run. The second, more subtle red flag is the perfect backtest. You'll see it as a beautiful, smooth equity curve that goes from the bottom left to the top right with barely a wiggle. Real trading is never that clean. Markets are choppy, unpredictable. A real, honest backtest will have periods of drawdown, times where the strategy loses money. It will have flat periods where it's treading water. If you see a perfectly straight line, you're likely looking at something called curve fitting. This is a dirty secret of system development, where the algorithm's rules are so hyper-optimized for a specific set of past data that it looks incredible. The problem? It has zero predictive power for the future, because the moment market conditions change, the perfectly fitted system shatters. You also need to check the duration and conditions of the backtest. A test run over the last 6 months of a strong bull market for the S&P 500 will look amazing for a buy-the-dip bot. But how did that same bot perform during the 2020 crash? Or the sideways grind of 2015? A robust backtest needs to span years, not months. It must cover different market regimes: trending markets, range-bound markets, high volatility events, and quiet periods. Finally, look for the fine print. Did the backtest account for commissions, spreads, and slippage? These are the real-world costs of trading. Many deceptive backtests ignore them, which can make a losing strategy appear profitable. A reputable developer will be transparent about these parameters. The backtest is their vehicle history report. Read every line. Second on our inspection checklist, the forward test. This is the test drive. A forward test, sometimes called paper trading or a walk-forward analysis, is when the AI strategy is run in real time on a demo or live account, but without risking real capital initially. This is non-negotiable. A backtest shows how it did perform. A forward test shows how it is performing. The market environment of today is always different from the past. A forward test is the bridge from historical theory to live-fire reality. And here, the standard of evidence gets even higher. Don't accept a screenshot of a MetaTrader account history. Those can be manipulated in seconds with Photoshop. What you are looking for is a verified third-party track record. Services like MyFXBook, FXBlue, or other reputable platforms can link directly to a trading account and analyze its performance independently. This creates a transparent, tamper-proof record. You can see the gains, the losses, the drawdown, the trade frequency, everything. If a vendor is truly confident in their AI, they should have no problem linking their live or demo account to a service like this for potential customers to see. If they refuse, or give you excuses about protecting their secret strategy, be extremely skeptical. A screenshot is a story. A verified track record is evidence. Always demand the evidence. Third on our checklist, and perhaps the most challenging, understanding the methodology. Many AI vendors hide behind the black box excuse. They say their algorithm is too complex, too proprietary to explain. And to a degree, that's understandable. They don't want to give away their secret sauce. But they must be able to explain the ingredients. They should be able to tell you the philosophy behind their AI. Is it a trend-following system designed to catch and ride long moves? Is it a mean reversion strategy that profits from the market returning to its average? Is it a breakout strategy? Does it use machine learning to identify complex patterns? Or is it a more traditional expert advisor based on a set of pre-programmed, if-then rules? You don't need a PhD in data science to understand the answers. But asking the question separates the serious developers from the snake oil salesmen. A developer who can say, "Our algorithm uses a recurrent neural network to analyze order flow and sentiment data to predict short-term reversals in major currency pairs," is giving you a concrete concept to evaluate. It shows they have a coherent strategic approach. A vendor who says, "It's a secret AI that just finds winning trades," is giving you a marketing slogan. One is a blueprint, the other is a bumper sticker. Always look for the blueprint. A lack of clarity on methodology often signals a lack of a sound methodology in the first place. Finally, the fourth and most critical point on our inspection checklist: the risk management protocol. This is where we check the brakes, the airbags, and the seatbelts. A strategy that can generate huge returns is absolutely worthless if it does so by taking existential risks that could wipe out your account in a single bad trade. This is the litmus test. The first metric to demand is the maximum drawdown. Drawdown is the measurement of the largest peak-to-trough drop the account has experienced. A 50% drawdown means at one point, the account lost half its value from its highest point. Are you comfortable with that level of volatility? A low drawdown is often a sign of a more stable, well-managed system. Next, how does the AI handle stop losses? Does every trade have a predefined stop loss to cap the potential loss? Or does it use a martingale-style strategy, where it doubles down on losing trades, hoping for a reversal? Martingale can look incredibly profitable for a long time, right up until the one trade that doesn't reverse and blows up the entire account. An AI without a clear, non-negotiable stop-loss mechanism is not a trading tool. It's a ticking time bomb. You also want to understand its position sizing. Does it risk a fixed percentage of the account on each trade, say 1 or 2%? Or does it use a fixed lot size regardless of how big or small your account is? A sophisticated approach to risk is a hallmark of a professional-grade tool. If the developer can't talk at length about drawdowns, stop losses, and position sizing, they haven't built a car with brakes. And you should never ever get behind the wheel. So there it is, the 4-point inspection. A deep dive into the backtest, a demand for a verified forward test, a clear explanation of the methodology, and a thorough examination of the risk management. This framework moves you from being a passive consumer to an active investigator. It equips you to cut through the marketing hype and make an informed decision based on data and logic, not emotion and promises. But even after you find a tool that passes this rigorous inspection, the work isn't over. Simply turning on a validated AI and walking away is one of the biggest mistakes a trader can make. The real skill lies in how you integrate this powerful new technology into your own personal trading plan, making it a co-pilot, not an autopilot. And that transition from operator to overseer is the key to unlocking its true potential. So what does that transition actually look like? How does a trader in, say, Dallas, Texas, go from being the pilot gripping the controls of every single trade to being the flight commander, overseeing a sophisticated AI co-pilot? It's not a switch you flip overnight. It's a fundamental shift in mindset, and it's best illustrated through a real-world scenario. Let's imagine a trader we'll call Mark. Mark is a typical US-based Forex trader. He has a demanding day job in tech, and he trades the Forex market part-time, mostly focusing on the London-New York session overlap when volatility is high. For years, Mark's routine was a grueling cycle of caffeine and charts. He'd wake up early, trying to catch the tail end of the European news, his eyes scanning candlestick patterns across his 3 favorite pairs: Euro to US dollar, Pound sterling to US dollar, and US dollar to Japanese yen. His process was entirely manual. He'd draw his trend lines, plot his Fibonacci retracements, and watch his moving averages, waiting for that perfect confluence of signals. But the market is a relentless beast. He'd find a great setup on the euro-dollar, but while he was managing that trade, he'd miss an even better one on the cable. He was constantly plagued by the feeling of being one step behind. His biggest struggle, like for many US traders, was emotional discipline. After a losing trade, he'd feel the sting of frustration, the urge to make it back on the next one. This revenge trading almost always led to bigger losses. On the other hand, after a string of wins, overconfidence would creep in, and he'd take on more risk than his plan allowed. He knew the rules. He had a trading plan written down. But in the heat of the moment, with real money on the line and charts flashing red and green, sticking to that plan felt like trying to stay dry in a hurricane. He was the operator, and he was getting exhausted by the sheer manual and emotional labor of it all. Then Mark started hearing about AI-powered trading tools. His first reaction was pure skepticism. He'd seen the ads for magic bullet expert advisors and black box systems for years. He dismissed it as just the next evolution of snake oil. But his curiosity got the better of him. He started researching not the get-rich-quick systems, but the legitimate AI platforms that offered analytical and automation tools, the ones that acted as assistants, not replacements. He realized the goal wasn't to buy a robot that blindly traded for him. The goal was to build his own. This is where the transition from operator to overseer began. His first step wasn't to give the AI any money. It was to give it his brain. He took his handwritten trading plan, his specific rules for entry, exit, stop-loss placement, and risk management, and began to codify it. He used a platform with a user-friendly interface that allowed him to translate his strategy into a set of logical rules the AI could understand. He wasn't telling it to find good trades. He was giving it explicit instructions. If the 50-period moving average crosses above the 200-period on the 1-hour chart, and the relative strength index is below 30, then alert me to a potential long entry on euro to US dollar. He was teaching the machine to see the market through his eyes. The second step was a game-changer: backtesting. Manually backtesting his strategy over a year of historical data would have taken Mark weeks of painstaking weekend work. The AI did it in under 5 minutes. The results were staggering. The AI ran his strategy through thousands of historical trades, revealing insights he'd never seen. It showed him that his strategy, while profitable overall, had a significant weakness during major news releases like the US non-farm payrolls report. It also identified that his win rate was almost 15% higher on Tuesdays and Wednesdays than on Fridays. He was getting a performance review of his own strategy backed by years of data instantly. He was no longer guessing, he was quantifying. He spent a week just refining his rules based on this data, tweaking parameters, and rerunning the backtests until the historical performance curve was smoother and more consistent. The third, and arguably most critical step, was forward testing in a demo account. This is where so many traders fail. They see a great backtest and immediately jump into a live account, Mark was smarter. He let his newly programmed AI copilot run his strategy on a demo account for a full month. He was now the overseer. Every morning, instead of hunting for setups, he would review the trades the AI had taken in the simulated environment. He wasn't just looking at the profit or loss. He was analyzing the decisions. Did the AI follow the rules exactly as he programmed them? Did it handle a sudden spike in volatility correctly? He was building trust in the system, but more importantly, he was training himself to think like a manager, not a frantic day trader. Finally, after a successful month in demo, he went live. But he didn't risk his whole account. He allocated just 10% of his capital to the AI-managed strategy. He was the flight commander, and this was the final system check before committing to the full journey. He watched it perform with real, albeit small, amounts of money. He saw it execute trades with zero emotion. It took a small, predefined loss without hesitation and without trying to revenge trade. It let a winning trade run to its profit target without getting greedy and closing it early. It was executing his plan with a level of discipline he, as a human, could only dream of. After another month, seeing the consistent application of his strategy, he gradually increased the capital allocation. Mark's life transformed. He no longer woke up with a jolt of anxiety to stare at charts. He would wake up, grab his coffee, and spend 30 minutes reviewing the AI's performance from the overnight sessions. Sessions he previously had to miss while sleeping. The AI had effectively become his night shift employee, monitoring the Asian and early London markets for him, flagging only the highest probability setups that met his strict criteria. His screen time plummeted from hours a day to less than an hour. His emotional stress evaporated. He was no longer riding the roller coaster of every tick up and down. Instead, his focus shifted to higher-level strategic questions. Is the underlying market condition changing? Is it time to adjust the strategy's risk parameters? Should I research and develop a new strategy for the AI to test on a different set of currency pairs? He had successfully transitioned from operator to overseer. He wasn't a manual trader anymore, but he also wasn't a passive investor. He had become a systems manager, a strategist whose primary job was to build, test, and supervise an efficient trading system. This new role leveraged his human intelligence and experience at the highest level, while delegating the repetitive, emotionally draining, and data-intensive work to the machine that did it best. This approach didn't remove him from the equation. It elevated him. And in doing so, it opened up a new frontier of psychological challenges and opportunities, forcing him to confront a whole new set of questions about trust, control, and the very nature of decision-making in the markets. This new reality was less about numbers on a screen and more about the landscape of his own mind. The first and most profound challenge was trust. It's one thing to trust your own analysis, your own gut feeling honed over a decade of wins and losses. You understand its flaws, its biases, its strengths. It's an extension of yourself. But trusting a silent silicon partner? That was an entirely different universe of faith. He would watch the AI execute a trade that, on the surface, seemed completely illogical. It would go short on the euro right after a positive economic data release from Germany. His old self, the manual trader, would have been buying with both hands. His fingers would twitch over the mouse. The impulse to intervene to correct the machine's perceived error was almost overwhelming. He felt like a pilot who had handed the controls to an autopilot in the middle of a storm, hearing the plane bank in a way that defied his every instinct. Was it a stroke of genius or a catastrophic bug? He had no way of knowing in the moment. This is the black box problem. And it's at the heart of the psychological battle for the modern AI-assisted trader. Many of the most powerful AI models, especially those using deep learning and neural networks, operate in a way that is not easily interpretable by humans. The system can crunch through millions of data points, from microsecond price ticks to sentiment analysis on financial news feeds, and identify a high-probability pattern that is simply invisible to the human eye. It sees relationships and correlations across dimensions we can't even comprehend. But it can't always explain why. It can't articulate its thesis in a way a human analyst would. Just presents the conclusion. And for a trader whose entire career is built on having a reason, a story, a thesis for every single position, this is deeply unsettling. You're asked to take a leap of faith, not based on a compelling argument, but on the historical backtesting of an algorithm. Ethan had to learn to sit on his hands, to let the trade play out, his heart pounding with a new kind of anxiety. It wasn't the fear of being wrong. It was the fear of being right for a reason he couldn't understand, or worse, being catastrophically wrong because of a flaw he couldn't see. This led to the second psychological hurdle, a phenomenon we can call algorithmic anxiety. This isn't the normal stress of watching a position move against you. It's a more persistent, low-level hum of unease. Did I configure the parameters correctly? Is the data feed clean? What if a sudden geopolitical event, a black swan, occurs that the AI wasn't trained on? The responsibility shifts. Instead of being responsible for the trading decision itself, you become responsible for the architect of those decisions. You're no longer the trader. You're the systems administrator, the digital mechanic. Ethan found himself checking not the market charts, but the AI's operational dashboard. Was the server latency low? Was the API connection to the broker stable? He wasn't worried about the euro to US dollar. He was worried about a memory leak in his Python script. This new anxiety was insidious because it was constant. The market closes, but the server runs 24/7. The potential for a silent, automated error to drain an account while you sleep is a uniquely modern nightmare. Then came the twisted, new version of an old enemy. FOMO, the fear of missing out. In traditional trading, FOMO strikes when you see a massive market move and you're not in it. You feel the greed, the panic, the urge to chase the price. With AI, FOMO is different. It's more subtle, more cerebral. Ethan's AI was designed for high-probability setups, which meant it was often inactive. There were days, sometimes even a full week, where the market was volatile, trends were running, and fortunes were seemingly being made every hour, but his AI did nothing. It sat there dormant, having calculated that the risk-to-reward ratio didn't meet its stringent criteria. The old Ethan, the human Ethan, would have been in the thick of it, scalping, trend-following, feeling the adrenaline. But now, he had to sit and watch, trusting that the AI's discipline was superior to his own impulsive nature. The FOMO wasn't about missing a trade. It was about the AI choosing to miss a trade that his human brain screamed was a sure thing. It was a battle between his emotional, pattern-recognizing human mind and the cold, patient, statistical mind of the machine. The greatest test of his discipline was no longer pulling the trigger, but not pulling the trigger, not overriding the system when his own instincts were screaming for action. Over time, another, more dangerous thought began to creep into Ethan's mind: skill atrophy. By outsourcing the heavy lifting of analysis and execution to the AI, was he losing his own edge? He realized one afternoon that he hadn't done a deep fundamental analysis of a central bank statement in over a month. He hadn't manually drawn trend lines or identified support and resistance levels himself in weeks. The AI did it all for him. He was becoming a manager, an overseer, but was he still a trader? The skills that had taken him a decade to build, the intuitive feel for market flow, the sixth sense for a reversal, he worried they were dulling like an unused muscle. This is a critical psychological crossroad for traders adopting AI. The fear is that the technology that's supposed to empower you might, in the long run, make you obsolete even to yourself. You risk becoming so dependent on the tool that you can no longer function without it. It was in the depths of this struggle that Ethan had his breakthrough. He realized he was framing the entire situation incorrectly. He was thinking of it as man versus machine. He was either trusting the AI or he was trusting himself. It was a binary choice, a power struggle. But the real answer, the next stage of evolution, was man and machine. This is the concept of the centaur. The term comes from the world of chess, where in the late 90s and early 2000s, it was discovered that a human player paired with a chess computer could defeat both the strongest human grandmasters and the most powerful supercomputers playing alone. The human's role wasn't to blindly follow the computer's suggestions. Instead, the human provided strategy, intuition, and a qualitative understanding that the machine lacked. The computer provided immense computational power, tactical precision, and an infallible memory of past patterns. Together, they were something more. Ethan decided to become a centaur trader. He re-architected his entire approach. The AI was no longer an automated black box that he simply switched on and off. It became his co-pilot, his ultimate analyst. The AI's job was to scan the markets 24/7, analyze dozens of currency pairs simultaneously, and flag only the highest probability setups according to his predefined strategy. It would present a potential trade to him, complete with its statistical analysis, key levels, and risk parameters. But it would not execute automatically. The final decision, the go or no-go, rested with him. This new model changed everything. It eliminated the black box anxiety because he was now part of the decision-making loop. It leveraged the AI's strengths, tireless analysis and computational depth, while integrating his own. He could now apply his decade of experience to the AI's suggestions. He could look at a setup flagged by the machine and say, "Yes, the data looks good, but there's a Federal Reserve meeting in 2 hours that you might not be properly waiting. Let's hold off." Or he could see the AI's suggestion and recognize a subtle pattern from his own experience that confirmed its logic, giving him the confidence to increase the position size. He was no longer just a systems manager. He was the commander, using an incredibly powerful intelligence officer to inform his strategic decisions. His skills weren't atrophying, they were evolving. He was learning the new essential skill of the 21st century trader: how to effectively collaborate with an artificial intelligence. This mental and strategic shift was far more important than any line of code he had ever written. It was the key that unlocked not just better performance, but a sustainable, psychologically sound way to navigate the markets of the future. This new philosophy transformed James's trading desk. It was no longer a frantic command center, but a strategic oversight hub. His mornings didn't start with a desperate hunt for patterns across 20 different charts. Instead, they began with a review. His AI co-pilot had already been at work for hours, digesting the overnight session in Asia and the early moves in London. It had scanned thousands of news articles, central bank statements, and economic data releases, cross-referencing them with price action and flagging anomalies. It presented him with a concise, prioritized briefing: a potential sentiment shift in the Japanese yen, an unusual spike in volume on the euro to US dollar pair that didn't correlate with any news event, and a backtest simulation suggesting his primary trend-following strategy might underperform if the day's volatility remained within a certain narrow range. He was no longer the chart watcher. He was the detective, and the AI was his team of informants bringing him all the clues. His role shifted from execution to interpretation. The AI could tell him that a specific candlestick pattern on the pound sterling to US dollar 1-hour chart had historically led to a bullish move 68% of the time over the last 5,000 instances. But it was James who had to overlay that statistical fact with the current geopolitical context. Is there a surprise Bank of England announcement scheduled? Is the US Federal Reserve Chairman about to speak? The AI provided the quantitative edge, the raw probability. James provided the qualitative, nuanced human judgment. This synergy, this partnership between human intuition and machine intelligence, was where the real alpha was found. And this revolution wasn't confined to custom-built systems in a Silicon Valley garage. As James was perfecting his co-pilot, a new wave of commercial AI-powered platforms began hitting the market, making these capabilities accessible to retail traders across the United States. Suddenly, you didn't need to be a programmer to leverage machine learning. These new tools fell into several distinct categories, each changing a different aspect of a trader's workflow. First, there were the advanced pattern scanners. For decades, traders were taught to spot patterns like head and shoulders, flags, and wedges. This required hours of screen time and a trained eye. AI scanners could do this in milliseconds across every currency pair, on every time frame simultaneously. But they went further. They could not only identify the pattern, but also provide a historical performance breakdown. Imagine clicking on a bull flag pattern the AI just identified, and instantly seeing data showing how that exact pattern performed on that specific asset during that time of day over the past 10 years. It quantifies the edge, turning a subjective chart pattern into a piece of actionable data. Next came the rise of predictive analytics. And we need to be very clear here. This isn't a crystal ball. It's about probabilistic forecasting. These AI models consume vast amounts of historical price data, order flow information, and even macroeconomic variables. They learn the incredibly complex, subtle relationships between these inputs and future price movements. The output isn't as simple, the price will go to X. Instead, it might be a volatility forecast, suggesting the likely high and low for the upcoming New York session. Or it might highlight high probability zones, where price is statistically more likely to reverse or accelerate based on past behavior. For a US trader, this could mean getting an alert that the US dollar to Canadian dollar pair is entering a zone that has historically preceded a major trend, allowing them to pay closer attention and look for their specific entry criteria. Then there's sentiment analysis, which moved from the exclusive domain of hedge funds to a subscription-based service. These tools use natural language processing to scrape millions of data points every day, from financial news outlets, analyst reports, social media, and forums. They analyze the language being used to describe a currency, determining if the overall tone is becoming more positive or negative, more hawkish or dovish. Is the market chatter around the Federal Reserve's inflation stance changing, even before the official announcement? An AI can detect that subtle shift in language, providing a potential leading indicator that isn't visible on a price chart. The emergence of these tools fundamentally redefines the skill set required to be a successful trader in the 21st century. The old skills, like the ability to stare at a chart for 8 hours straight and manually spot a single pattern, are becoming obsolete. They're being automated. The new premium skills are different. The modern trader is becoming less of a pattern spotter and more of a system architect. Their job is not to find the trade, but to build and manage the system that finds the trades. They are the ones who define the rules, who select the inputs, who tell the AI what to look for. This has created a new discipline that we might call strategic prompt engineering for the markets. Just like getting a useful answer from a language model requires a well-crafted prompt, getting a useful insight from a trading AI requires asking the right questions. A novice might ask, is the euro going up? A professional, AI-augmented trader asks, what is the historical probability of euro to US dollar breaking its 20-day high during the New York session when US jobless claims come in 5% below consensus? And what is the average follow-through over the next 24 hours? The AI can answer the second question, cannot answer the first. The value is in the specificity and intelligence of the query. Furthermore, the trader's role as an interpreter becomes paramount. The AI might flag 15 potential setups in a morning, each with its own probability score and risk profile. The human trader is the final filter. They must bring their own market experience to bear, asking critical questions. Does this high probability setup on the Australian dollar make sense given the recent data from China, its largest trading partner? Does this AI-generated signal on the Swiss franc align with the broader risk-on or risk-off sentiment in the global markets? The AI provides the data-driven candidates, the human makes the final context-aware decision. It's about data interpretation, not just data generation. Of course, this new world is filled with its own set of sophisticated traps for the unwary. One of the biggest is the black box problem. Some commercial AI tools are intentionally opaque, marketing themselves as a magic box that spits out signals. A trader who relies on such a system without understanding its underlying logic is flying blind. When the system inevitably hits a losing streak, as all systems do, they will have no idea why it's failing or how to fix it. They'll be trapped, either abandoning the system entirely or continuing to trust it as their account dwindles. The most effective traders demand transparency, or at the very least, a deep understanding of the types of inputs and models their AI tools are using. Another major pitfall is a concept from machine learning called overfitting. An algorithm can be trained on historical data so perfectly that it becomes brilliant at explaining the past, but useless at navigating the future. It has essentially memorized the old price action rather than learning the underlying principles. A trader might backtest an overfitted AI strategy and see incredible historical results, only to find that it falls apart in live market conditions, which are never an exact replica of the past. The human operator's job is to be the skeptic, to constantly stress test the models against new data and different market conditions, ensuring they are robust and adaptable, not just a fragile reflection of history. Ultimately, the timeless principle of garbage in, garbage out is magnified with AI. An AI is a tool, a powerful amplifier. If you feed it a flawed trading idea or bad data, it will not correct you. It will simply execute your flawed idea with incredible speed and efficiency, amplifying your mistakes. The ultimate responsibility, the final layer of risk management and strategic oversight, can never be outsourced. It always remains with the trader. This new reality demands a new kind of trader. It's no longer enough to be a master of technical analysis or a guru of fundamental news. The successful US trader of tomorrow, and even today, is becoming a master of synthesis. They are the conductor of an orchestra, where some instruments are their own hard-won experience and intuition, and others are incredibly powerful data-driven AI systems. The magic, the alpha, is found in how you bring them all together in harmony. Think of it this way. For decades, the edge in trading was information. If you got the news a few seconds before everyone else, you had an advantage. Then it became processing speed. High-frequency trading firms built microwave towers to shave milliseconds off transaction times. Now, the new frontier, the new edge, is interpretation. We are all drowning in the same ocean of data. The winners will be those who build the best boats, the best AI models, to navigate that ocean and find the meaningful currents that others miss. So what does the future hold? Where is this all heading in the next 5 to 10 years? We're moving beyond AI as just an analysis tool, and into the era of the AI as a true co-pilot. Imagine a system that doesn't just identify a potential trade setup, but also understands your personal trading psychology. Based on your past trades, it might flash a warning. You have historically oversized your position in volatile markets. Historical data suggests a 30% reduction in position size for this trade aligns better with your stated risk tolerance. This isn't just data analysis. It's personalized behavioral risk management, happening in real time. We'll also see the rise of what we can call generative strategy AI. Instead of you spending weeks backtesting a new idea, you'll be able to prompt an AI with specific parameters. For example, design a trading strategy for the US dollar to Japanese yen pair that only operates during the Tokyo session, uses a combination of momentum and mean reversion principles, and has a historical Sortino ratio above 2. Show me the backtested results over the last 5 years, including periods of high and low volatility. The AI wouldn't just give you a yes or no. It would generate the code, the results, and a detailed breakdown of the strategy's strengths and weaknesses. The trader's job then shifts from manual labor to creative director, guiding the AI to build and refine strategies that fit their overarching market view. This evolution brings a profound shift in the necessary skill set. The trader of the past was a chartist, an artist reading the tea leaves of price action. The trader of the future is an architect and a data scientist. Your value will not be in your ability to spot a head and shoulders pattern faster than someone else. Your value will be in your ability to ask the right questions of the data. Your value will be in understanding the statistical models your AI is using, recognizing their limitations, and knowing when to override them. The question is no longer just, what is the chart telling me? The question becomes, is my model interpreting this data correctly? Is there a contextual factor, a geopolitical event, or a shift in market sentiment that my algorithm, trained on historical data, cannot possibly comprehend? This requires a deeper level of critical thinking. It means you need to be as fluent in the language of probability and statistics as you are in the language of support and resistance. For traders here in the United States, this technological arms race will also play out against a backdrop of evolving regulation. The Commodity Futures Trading Commission, or CFTC, and the National Futures Association are not blind to this trend. They are intensely focused on algorithmic trading, and AI is the next logical step. Expect to see future regulatory frameworks that demand greater transparency from platforms and tool providers. There will likely be a push for explainable AI, where a system has to be able to articulate in simple terms why it recommended a particular trade. This is a good thing. It pushes back against the black box problem and ensures that traders remain in control and understand the tools they are using. It will also likely lead to higher standards for risk management controls on retail trading platforms that incorporate AI, creating a potentially safer environment for everyone. So, how do you prepare for this future? How do you avoid being left behind? The first step is to embrace a mindset of continuous learning, but with a new curriculum. It's time to add some new subjects to your study list. You don't need to become a PhD in computer science, but understanding the basic concepts of machine learning is becoming essential. Learn what a neural network is. Understand the difference between supervised and unsupervised learning. Grasp the concept of overfitting, where a model performs brilliantly on past data but fails in the live market. There are countless online courses and resources that can teach you these fundamentals. Second, start integrating AI-powered tools into your process in a gradual, low-risk way. Don't jump straight to a fully automated trading bot. Begin with AI-driven news aggregators that filter for market-moving events relevant to your currency pairs. Use advanced sentiment analysis tools that scrape social media and news sites to give you a real-time gauge of market mood. Use AI-enhanced charting platforms that can identify complex patterns you might have missed. Get comfortable with the technology. Learn its strengths and, more importantly, its weaknesses, in a controlled environment where your capital is not at significant risk. Third, and perhaps most crucially, start thinking like a quantitative analyst even if you're a discretionary trader. Every trade you take is a hypothesis. You are hypothesizing that based on a set of conditions, a certain outcome is more probable than another. Start documenting this rigorously. What were the exact data points that led to your decision? What was the outcome? Build your own personal database. This disciplined, data-driven approach is the foundation upon which all AI and algorithmic trading is built. By adopting this mindset, you are essentially training yourself to think in the same logical, evidence-based way that these powerful systems operate. In the end, this entire revolution is not about replacing the human trader. It's about augmenting the human trader. AI is a tool, the most powerful tool we have ever had in the financial markets, but it is still just a tool. It lacks genuine creativity. It has no intuition. It cannot understand the nuances of a sudden political crisis or a global pandemic in the way a human can. It can process the past with blinding speed, but it cannot dream about the future. The ultimate competitive advantage, the enduring edge in the age of AI, will be the seamless fusion of human insight with machine intelligence. It will be the trader who can use AI to analyze millions of data points to identify an opportunity, but then use their own experience and intuition to decide whether the context is right to take that trade. It will be the trader who can design a brilliant automated strategy, but also has the wisdom and discipline to turn it off when the market environment changes. The future of Forex trading isn't a battle of human versus machine. It's a partnership. And for those US traders who are willing to learn, adapt, and embrace this new paradigm, the possibilities are more exciting than ever before. You are not just a trader anymore. You are a pioneer on a new frontier, armed with tools that the legends of the past could only have dreamed of. The journey is just beginning.